Good day, and welcome to our presentation entitled International Capital Budgeting and Currency Exposure. Your presenters for today include myself, Devashilan Pillai, Triyaska Naidu, Keegan Naidu, Trayam Gopal, Ricardo Padiachi, Lindakushla Lushaba, and Namishka Rambaran. So let's get into it. International capital budgeting refers to when multinational corporations wish to undertake investments in countries outside of their borders. These firms are therefore exposed to exchange rate fluctuations, which is known as currency exposure. These multinational corporations are therefore exposed to additional risk and regulations in the country outside of the border. This presentation is going to cover the various ways in which these companies are able to invest in the foreign exchange market, as well as the capital budgeting practices which they were known to undertake. We are also going to explore the ways in which these companies can measure and hedge their foreign exchange exposure, as well as the role of the cryptocurrency in managing foreign exchange exposure.
International capital budgeting requires a company to be aware of the various approaches available to them to allow them to invest in foreign currency. I will now go through the various avenues with you. The first is using the spot market. This market allows traders to buy and sell an underlying asset at the current prevailing market price. The transactions in this market take place relatively quickly, and it was found that a third of the business transactions involved were that of currency exchanges, with the trade settlement happening within 1 to 2 days. Overall, the primary transactions that occur in this market involve the buying and selling of currency, the cash-ins of travelers' checks, as well as the transfers between banking systems. Another avenue is that of the forward market through forward contracts. The forward contracts is an agreement between two parties where one party agrees to buy or sell an underlying asset to another party at a predetermined price, date, as well as quantity of the asset. These markets are characterized as over-the-counter, and the contracts can be customized according to investor preferences. Furthermore, these contracts do not require a large initial outlay and are usually offered to large credit-worthy corporations. An alternative approach would be to use option contracts. These contracts provide their holder with the right but not the obligation to buy or sell an underlying asset at a predetermined strike price and expiration date. There are two types of options available, a call option or a put option. A call option provides their holder with the right to buy a specific asset, whereas a put option provides its holder with the right to sell a specific asset. With regards to the exercise of these options, it depends based on the market you're in. For an American market, you are allowed to exercise your option on or prior to the expiration date, whereas with the European market, you are only allowed to exercise your option on the date of expiration. Another approach would be to use the foreign bond funds. So these are mutual funds that invest in foreign government bonds, and they're usually denominated in the country of sales currency. These international bonds offer or have shown to improve the ability and willingness of investors to increase their risk as they are able to reduce their political instability. An example of this would be a samurai bond that is issued by a non-Japanese business in Japan. An additional approach is that of the foreign currency certificate of deposits. These are available as single currency or currency baskets and aids the benefit of foreign interest to investors. They are available via brokerage firms or commercial banks and are fairly flexible in that they offer a range of maturity dates. However, if you are to withdraw prior to maturity, you will be given a penalty. Finally, exchange-traded funds. These are investment tools that offer a similar return to that of a benchmark, like an equity index. They are traded via stock exchange and offer a simple and low-cost means for investors to obtain a well-rounded portfolio.
Economists and theorizers have advocated for many capital budgeting techniques. However, the difference between theory and real-world viability shows itself in what techniques firms actually use. It is not uncommon for firms to use methods that may be less theoretically sound because they are simpler to use. In the 1950s, the rates of return were seen as the most efficient techniques. However, this method was only adopted by a small number of firms, while relatively smaller firms use the payback method. Rossi researched Italy and found that the payback method was still popular, even more than methods like NPV. It was found that education level and firm size, as well as a lack of appropriate training in decision making, led to this. A Swedish study by Hoffman and Pramberg found that the NPV and payback method were most common. They found that simpler methods are used with management of smaller firms that tend to have less specialized training. A study by Jog and Srivastava in 1995 found that the DCF and quantitative methods like sensitivity analysis were used in Canada. This study also noted the adoption of more subjective or informal compared to formal methods being used. In particular, 23.1% of respondents claimed to use no formal method of risk analysis, but a study by Clamer and Walker in 1980 found that 41% of respondents indicated no formal methods were used. This could indicate that more sophisticated methods were used as literature about it increased. A comparative study was conducted between China and Netherlands, with the main findings were that Dutch companies used NPV while Chinese companies favored the rates of return method. This may be due to the differences in the development of the countries. However, it was also found that there were no significant difference in the use of IRR or the cost of equity techniques such as CAPM. Jog and Srivastava found that the IRR was preferred over NPV in Canada, and Pike found a similar result in the UK. The tendency to favor IRR came to simplicity. Earnhardt and Brigham found that the payback method was used as a complement to other methods, especially the NPV method. The payback method is used as an approximation of risk during the early stages, which is then followed by a more sophisticated method like NPV. Empirical evidence suggests that managers may often trust their own judgment more than the theory and may prefer simpler rather than complex methods. Also, that the economic development of a country might influence the methods chosen.
There are three main exposures faced by multinational corporations, namely transactional exposure, economic exposure, and translation exposure, each of which will be discussed. Transaction exposure can be defined as the sensitivity of a company's foreign currency cash flows to changes in the exchange rate. Practically speaking, it occurs when the money a company plans to receive or pay deviates from the expected amount due to an appreciation or depreciation of the relevant currency. This money can be a result of foreign lending or borrowing, buying foreign assets, or forward foreign exchange contracts. To identify these transactions on a balance sheet, typically look for the accounts receivable and monetary debt inputs. Economic exposure can be described as the extent to which unforeseen changes in the exchange rate will influence a firm's value. Practically speaking, a change in the exchange rate may affect the demand and/or supply of a company's goods in a foreign market or the present value of cash flows in that foreign currency. Economic exposures are often difficult to understand and manage, as they require careful, unbiased analysis of an NMC's operation locations, processes, and currencies utilized. One can divide economic risk into two subcategories: sensitivities of the future home currency value of the firm's assets and the sensitivity of a company's operational cash flows to changes in the exchange rate. It is important to understand the impact an appreciation or depreciation will have on a firm value. For example, domestic sales will increase a firm's value if the domestic currency depreciates, but decrease firm value if the domestic currency appreciates. However, importing goods for domestic sales in foreign currencies will increase a firm's value if the domestic currency appreciates, but decrease it if there's a depreciation. Translation exposure can be defined as the effect of an unpredicted exchange rate change on a company's financial statements. Practically speaking, it involves viewing assets and liabilities that are tied up in a foreign subsidiary in terms of the parent company's domestic currency. Being related to corporate reporting, these inputs on a company's financial statements can be deceptive to potential investors, as determining the true value of assets, for example, can take a long time. There are four methods to translate foreign subsidiaries' financial statements, which will now be discussed. Under the current rate method, assets and liabilities are divided into groups depending on the maturity, because current account items mature in shorter periods and their value varies as the exchange rate changes. The income statement components are translated either using the actual exchange rate on the dates the various revenues, costs, profits, and losses happened, or a weighted average exchange rate of the period. Under the current or non-current method, non-current account items are converted using the historical exchange rate in force at the time the item was initially recorded in the book, whereas current account items are converted using the current exchange rate. The income statement components are translated again, this time using either the actual exchange rate or a weighted average exchange rate for the period. In the monetary or non-monetary method, the value of monetary products will fluctuate, but the value of non-monetary objects will not. Inventory, long-term investments, and plant and equipment are all translated at the historic rate, whereas accounts receivable, payable, cash, and long-term debt are all translated at the current rate. Lastly, the temporal method is quite similar to the monetary and non-monetary method. It mainly differs in its treatment of depreciation and cost of goods sold, in that depreciation and cost of goods sold are only translated at historical rates if the associated balance sheet accounts are also carried at historical rates.
The following section will cover the different types of financial market hedges. The first is a forward market hedge. Using a forward contract, the firm can set a predetermined exchange rate to convert their foreign payment or receivable, therefore ensuring that short-term volatility in the exchange rate is cancelled out. One disadvantage to consider is the situation in which the spot market exchange rate is more favorable, such that the firm pays more or receives less in value than it would without a forward hedge. In this case, the firm would not benefit from the favorable move and would have to settle for the rate agreed upon. Second is a money market hedge. This involves a process of borrowing and lending at domestic and foreign interest rates, which essentially creates an effective future exchange rate for the firm to convert its payables or receivables. This technique also has a disadvantage of not benefiting from favorable movements in the spot exchange rate. The last financial hedge is a currency option, which will give the firm an option to exercise their foreign payable or receivable at a specific exchange rate. Its main advantage is not only that it hedges downside risk, but also that it gives the benefit of profiting from favorable spot exchange rate moves. One disadvantage is that if the cost of the premium is too high, it could result in further downside risk. The second type of hedging is operational hedges. The first operational hedging technique is an invoice currency hedge. This involves a firm setting a preferred currency for all charges to its customers. The firm will usually choose a currency that is stable and liquid, such as the most famous US dollar. The second is a leading and lagging hedge, which is a strategy that involves speeding up or delaying a payable or receivable based on whether the firm expects the foreign currency to depreciate or appreciate. For example, an importing firm that expects a depreciation of the foreign currency will delay its payable in order to pay less in value. A major disadvantage is that it depends on timing, the market, and predicting future exchange rates, which can be an extremely risky process in itself. Past studies find that financial market hedges compared to operational hedges are much more popular among multinationals than smaller independent firms. The reason is that multinationals have larger transactions over larger volumes and over a variety of currencies. They also find that the most popular financial hedge is forward hedging, while the most popular operational hedge is inverse hedging.
Economic exposure, which is derived from transaction exposure, is determined by the market structure and the ability for a firm to alter its sourcing and product range. A study conducted in 2020 found that depending on the firm's size, economic ratios, and earnings variability, the company will be more prone to economic exposure. Hedging economic exposure ensures that cash flows remain stable irrespective of the exchange rate risk. Ways to hedge economic exposure include selection of low-cost production sites. This involves strategically selecting where to develop production factories in regions that are most cost-effective. Also, financial hedging brings cash flow stability, and this is done by accounting for real exchange rate risk. Translation exposure is the risk that a company's equities, liabilities, and assets or income will change in value as a result of the exchange rate risk. Multinational corporations are discouraged from hedging translation exposure due to the reduction of firm value, hedging costs, and the potential failure of hedging. Therefore, this is not a priority for multinational corporations. Hedging translation exposure can be achieved in two ways. One, by conducting a balance sheet hedge, which is a technique where companies utilize loans with the aim of reaching the equal amount of liabilities and exposed foreign currency assets on the consolidated balance sheet. The idea is that the change in the exchange rate will impact liabilities and assets in equal but opposite ways. Another way is known as derivative hedging. This is used to minimize the cash flow volatility by speculating on foreign exchange rates.
So, what is cryptocurrency? A technical definition would describe it as digital currency that has been built on the foundations of blockchain technology. The purpose behind its creation was to complement and act as a substitute for government-backed securities. However, unlike the traditional currency we are used to, the value of cryptocurrency is determined by the value assumed by its investors, rather than the economy of a country. Despite this being the most unique characteristic of cryptocurrency, this is just one amongst many, as it has faster transaction settlement and improved security, increasingly volatile value, making it particularly attractive to risk-seeking investors, decreased transaction fees, and lastly, limited regulation. Despite cryptocurrency's increasing popularity, many are unsure as to how it actually works. The blockchain in the context of cryptocurrencies functions as encrypted peer-to-peer network and virtual ledger and facilitates payments between participants. Within the blockchain network, a digitally encrypted key is allocated to virtual network such as Bitcoin, where the parties engaged in the transaction sign and transfer the data to another user, all while publicly recording the transaction. Despite no direct link being found between cryptocurrencies and exchange rate, it has been observed that the volatility of cryptocurrencies returns in actuality moves in tandem with the global foreign exchange market. It was further found that the market efficiency of respective cryptocurrency varies over time, according to the adaptive market hypothesis, such that market efficiency improves as a cryptocurrency becomes more widely used as a means of transacting. It can therefore be deduced that having cryptocurrencies within a portfolio could potentially be used as a hedge against foreign exchange market volatility. One of the biggest upsides related to cryptocurrency arises due to certain cryptocurrencies having a maximum number of coins in issue, as this leaves no possibility for inflation to develop within the crypto market. Furthermore, the decentralized nature of cryptocurrency allows the value of an arbitrary cryptocurrency to be constant across the world. Thus, although the conventional currency cost of an arbitrary cryptocurrency may vary depending on market volatility, the intrinsic value of the cryptocurrency remains constant. It can thus be asserted that even though creation of cryptocurrency was not made to specifically address the problems of exchange rate exposure, its unique nature does offer benefits compared to transacting via the traditional government-backed security.
Due to the increase in globalization in recent years, the foreign exchange market serves as an integral part to the success of multinational corporations. There are various ways in which these firms can invest on the foreign market, as well as to determine the viability of their investments such as NPV, DCF, IRR, and sensitivity analysis. Due to this foreign exchange exposure, it has a huge impact on the multinational corporations' international capital budgeting practices because of this exchange rate fluctuations. Thus, these firms are able to control for this risk through hedging practices such as invoice currency exposure netting as well as diversification. Some studies have associated cryptocurrency with unpredictable volatility and uncertainty. On the other hand, other studies state that cryptocurrency moves with foreign exchange volatility, and due to its intrinsic value remaining constant across borders, it serves as a good hedge. Furthermore, the decentralized nature as well as security of the cryptocurrency proves it to be a wise investment choice for multinational corporations in hedging their foreign exchange exposure. And that brings us to the end of our presentation on international capital budgeting and currency exposure. We do hope that we were able to supplement your knowledge on this important concept in finance, and please do feel free to ask us questions at the end.